Thank you for participating in the Money Matters program. For those of you who received this book, the pages will be on the bottom of this video. For those of you who did not receive a book, you can access this information on our website, www.dhfunforkids.com. Welcome to Session 5 of the Money Matters program. To start today's session, we want you to think about this question. You have two options. You can take $1 million today or 1 penny today. However, the trick with the penny is that penny doubles every day for 31 days. In this session, we will speak about investing, banking options, and different cards you may receive from financial institutions. Now we are going to go back to that question that was asked earlier. Which option did you choose? If you chose the million, congratulations, you have $1 million. If you chose the penny, it is now worth over $10 million. First in today's session, we are going to discuss cards you may receive from financial institutions. First one is an ATM card. This is a card you can receive, and it's to withdraw for money from a financial institution's automated teller machine. The next one we have is a debit or check card. This is like an ATM card, but you can use it at a store or online, and the money is directly taken from your checking account. If you do not have enough money, your card can be declined, or you can pay a sizable overdraft fee if the transaction goes through. Next, we have a credit card. Credit cards are not directly taken out of your account. You get them from a credit card company. If you do not pay your bill back monthly or late, you can be charged with high interest rates or fees. Now we're going to look at some specific financial institutions. There are three types of financial institutions we're going to discuss today: banks, credit unions, and check cashing stores. So let's go ahead and talk about them. We're going to start with banks first. Banks are insured by the federal government. They offer a range of different accounts. Big banks have branches in lots of locations. They do not charge to deposit a check into your account, and money can also earn interest. Now let's talk about credit unions. Insured by the federal government as well. They're a not-for-profit cooperative financial institution. Money is generally kept in the community to help the community. They do not charge to deposit a check into your account either. Generally lower monthly fees than banks, and money can earn interest. Now let's talk about check cashing stores. Will cash your paychecks at a large fee, provide fewer services than a bank, and charge much more. And the last thing, money paid will never grow interest. Take some time now to think about a financial institution that may be best for you when you open up a checking account. Here are some things to think about when picking an account. Does the institution charge fees, or do they offer a free account? Will they have enough locations to meet your financial needs? Like if you are going away for college and you want to make sure the institution is in the area that you are attending college. Now we are going to conclude today's session by speaking about investing. Before we discuss investing, I want you to think about three people: John, Melissa, and Jeff. For the purpose of this activity, we are estimating each receive a 9% return on their investments. So let's go ahead and look at them. John invests $1,000 each year from the ages of 16 to 25. Melissa invests $1,000 each year from the ages 26 to 50. And Jeff, he invests $1,000 each year from the ages of 16 to 50. Which person do you think will have the most money? Which will have the least amount of money? And who is in the middle after they reach the age of 50? Now we're going to look at when you may want to start investing. It is important to understand that we are not investment specialists, but we do have a small guideline that may help you. If you can agree with these statements, then you may be ready to invest. I have a steady job. I stick to my monthly budget. I regularly put money in my savings account. I have researched and tried to understand different investment options. I understand the risk involved in investing. I have extra money to invest that I don't need access for at least 5 years. Now let's go back to our three investors. It's actually Jeff who was number one. He ended up making over $215,000. In the middle was John. He made over $131,000. And number three, Melissa. She made over $84,000. As you can see, the earlier we start to invest, the more benefits we receive in the future. Thank you for participating in today's session.